Hey, Dan here. I want to thank you for attending this really short webinar. It's about 10 minutes of your time, but as we enter tax season, I believe it's crucial to evaluate your client's rental properties in a structured, systematic, and meaningful way. Rental real estate often represents a significant yet often overlooked component of their financial plan. By eliminating this blind spot, you can help clients and help your wealth and security just as my team has done. Today, we're going to analyze key sections of the Schedule E federal tax form to assess rental property performance. You're going to learn how to uncover quality financial metrics, opportunities for improvement, and I'm going to provide you valuable resources to enhance your advisory capabilities. So let's dive in. Why now? Well, rental real estate is often your client's largest asset class. Ignoring it means missing a critical component of their financial plan and potentially leaving wealth on the table. Neglecting real estate can also commoditize your role. If you're not discussing it, I'm not sure you need to solve it if there's a problem, but if you're not discussing it, someone else will. Your value is tied to the depth of your insights, and often overlooking rental properties weakens your position as a trusted advisor and a holistic advisor. Third, the rise of AI and robo-advisors is reshaping financial advice. Clients have more automated options than ever before. To stay relevant and indispensable, you must go beyond traditional investment discussions and help them maximize all aspects of their portfolio, including rental real estate. Finally, this is your opportunity to strengthen the client relationships, deliver greater value, and differentiate yourself in a very rapidly evolving market. Okay, let's dive in. This is the top of the Section E, which is the schedule that is part of the federal 1040 return, where supplemental income, such as rental real estate, appears. If your client owns rental real estate, this is most likely where the financials of this property will show up. Not 100% of the time, but probably 98 to 99% of the time. Okay, first step. Let's get into the evaluation. We're going to check the address, which is at the very top. If there's multiple properties, there's different columns. But we're going to determine the value. You or your assistant can easily go to Zillow, Redfin, or our product, HomeBot, to determine an estimated market value. This is important as we will discuss a key financial metric coming up, and one component of our calculation is the value of the home. Check multiple places for this value and ask the client what they think the home is worth. They could have made major upgrades that aren't reflected on Zillow and Redfin. Write this number down, save it for later. You're going to need it. In our example, I'm going to use $1 million for easy math. Step 2, fair rental days. You'll see this in section 2, the fair rental days. This is going to help us calculate the monthly rent, but also open our eyes as to something that may be going on, such as trouble finding a tenant or major repairs. Again, keep this number handy for our next calculation, but be alert for trouble here with this property. My property, the number's low. This might signal dissatisfaction with this investment vehicle. Third, rental revenue. Section 3, we're going to find the rental revenue here. Obviously, this is an annual number, so we're going to need to do some math to get to the second financial metric, which is monthly rent. In our case, the home was rented for 6 months. 180 days was reported on the previous step. So we're going to divide 6 into that 24,000 to arrive at 4,000 per month. This is what we're going to use in our next calculation. This brings us to a key filter for me and my team, where we invest and how we really take our first step. What is the rent to home value number? The metric we use is called the 1% rule, or 100 basis points, and that's a goal we try to hit with our investment property purchases and the markets we invest in. We speak in bond terms, and in our example here, my example, we've got 40 basis points. When looking at other locations around the country, this is terrible. 40 basis points is really bad. The problem is It's not unusual here in Southern California. We have learned that many other markets perform much better. So when we see a number below 55-ish, we really get into discussion and create awareness on what's going on in other markets. Currently, we're invested in homes in Michigan in one of our syndications that's producing over 120 basis points, 3 times this monthly, or excuse me, this metric. If your client is north of 80 basis points, awesome. Give them a thumbs up. That's a very, very good number. Anywhere between 80 and 55, we like to have this discussion, find out what's working for them and what's not. Once again, the 1% rule, just to hammer this home. When you look at the value of the home, we want to try to get 1% of that, or the purchase price. So if they're buying a home for $500,000, can we get $5,000 a month in rent? In Southern California, not even close. Other markets, we're in Memphis right now getting 65-ish basis points, almost 50% more than what we experience here in Southern California. Interest expense. In these next 3 steps, steps 4 through 6, we're not going to use too much math in our calculations. Once again, this is to create awareness and get into a discussion with your client. First up is interest expense. Is there interest expense? Our example shows $15,000, which means there's a mortgage on the property. What are the terms and the conditions of this mortgage? Are they paying too much interest? This is where you can bring us in to vet this line item to ensure that a suitable and efficient mortgage is in place. And if it is, fantastic, we'll let you know. But we want to make sure their mortgage and liability plan is in alignment with their life and financial goals. The flip side here is, what if there's nothing? What if there's zero expense being reported? Do they not have a mortgage? Is that the right financial move? Could they benefit from some leverage? Once again, just at a discussion point. Step 5, repairs. This can be an eye-opener. There's no hard and fast rule here, but a couple of things concern us. Too much. Is it really, really high? What's going on? Is this a symbol of this home is deteriorating and they're spending a ton of money? Or if it's zero, that can be a problem too. So many investors that have one property or maybe 2 properties they've owned for a long time, when you see a zero there, it's a problem, because there should be ongoing repairs, because what we don't want to have happen for our clients is this doomsday type year where they're spending $50, $100, $200,000. We see it all the time, and we try to create awareness on what is the maintenance plan with their rental properties. Step 6, depreciation. You'll see line number 18 here. In our case, why is there no depreciation? Have they fully depreciated a home, or has someone make a mistake in tax preparation? We have experienced this twice in the last 12 months where clients came to us, we looked at their returns, and there was no depreciation, and there should have been. The tax person just missed it, costing them thousands of dollars in income tax that they should not have paid. Depreciation can sometimes be defined as the superpower of owning rental properties. So once again, nothing to solve here other than create awareness in what's going on with this number. So clients say, well, Dan, what choices do I really have? Choice 1 is you sell the property and reallocate your money to other investment vehicles, whether it's stocks, bonds, other properties, something different. A lot of times that's the advice, or that's the path the client takes. 2, a 1031 exchange to another market for like-kind real estate to increase that top-line revenue. Or 3, hold the property and work on operational and financial improvements. Quick primer on a 1031. What is a 1031? It's an exchange that allows real estate investors, must be investment properties, to defer capital gains tax by reinvesting the proceeds of the sale in a like-kind property within a specified time frame. This strategy helps investors grow wealth tax efficiently by keeping more capital working for them instead of paying immediate taxes. Once again, the key is rental property. It can be selling one rental property and buying 2, 3, 4. We've done that recently. So it doesn't have to be one single family home for one single family home. The total sale price has to be met with the new purchase, and the indebtedness must be carried with them as well. This is one final question that we ask our clients. Do they have rental income exposed to tax? You'll see this bottom line on the Schedule E. If so, why are they paying tax? Is there a more efficient plan possible? Again, we're not asking you to create a tax strategy for your client, but it's a discussion that should be had. A great way is to enlist the CPA, their tax professional, into the discussion and find out, is this the best path? And it may be, or is there a better path out there? So, bringing it all together, our 3 steps is we like to evaluate the current financial performance of the property. Second, understand the legacy and emotional issues, if any, with this current property. Does this property have a family emotional tie that they're not going to sell? Well, then we need to leave it alone. And then third, if they want to get into this discussion, we're going to compare and contrast what's going on in the market they're in now and in a different market in a different place around the country. We have experience doing this, and it's proven life-changing for many of our clients. Then finally, we're going to integrate it into your financial plan with your client. Are we increasing cash flow? Are we decreasing tax expense? And how does it fit into their current plan and their retirement? So it's a great opportunity when onboarding new clients or doing annual reviews. In addition, we have webinars created with the people at Money Guide Pro and eMoney on how to properly model real estate into a financial plan. I'm happy to share those with you. If you need access, just shoot me a message. Support material. Our latest book is on Amazon. It's our experience with investing in other markets and our syndication, which we have in Detroit or north of Detroit and in the Memphis area as well. So I think I highly recommend it. It's been well received and it's a quick read. Here's the support material. I put a document together, and I'm not going to show it here, but I could put a worksheet together for your assistant to be able to go in and hit 1, 2, 3, 4, 5 or 1, 2, 3, 4 really quickly and create this spreadsheet for this awareness that we talked about. This isn't the end all be all, but it's a great filter to compare cash flow of the current property with other markets. Our survey shows 80% of our investor clients prefer cash flow returns over appreciation. It makes sense. They want to make money on an ongoing basis. The only way to take advantage of appreciation is to sell the property or refi out of it to get cash. That's the only way to take advantage of appreciation. So once again, our survey has shown that many people prefer the cash flow. Finally, let me know if you don't have access to support material at Financial Experts Network. I can give you free access here. This amazing resource offers webinars for financial professionals just like you, over 100 webinars a year, typically an hour or two, and often CE approved. So just email me if you don't have access or you're having trouble logging in. I would love to provide it for you. It is fantastic. Please take advantage of it. That's it. Threw a lot at you, but I love the 1% rule. I want you to help your clients understand rental real estate. We've got a lot of case studies available to show the life-changing events we've put in place for our clients. So I'm here to help. Thank you so much for your time, and I'll look forward to talking to you.